So this is a schematic representation of what's in policymakers' minds. This is not inflation and employment. It is concerns about inflation and employment. So in this period here, nobody was worried about inflation because it hadn't been. And so employment was the only thing that people cared about, and vice versa, they didn't. And the idea is that thesis is that people get what they're not worried about. So why did Nixon take that decision to close the gold window? And the roots of his decision lie in the 1960s. So in 1965, which is this period here, this period here, we had enjoyed inflation rates of somewhere between 1 and 1.5 in the US for 5 years. And unemployment was coming down steadily until, by the time we got to 1965, it was generally considered that the US economy was fully employed. In 65, Johnson came into the White House, and he inherited the Vietnam War. But he also had huge ambitions to help the poor and the middle classes, and the American version of the middle classes. So he introduced his Great Society program, which included the founding, for instance, of Medicare and Medicaid. So that was very effective, but it was very expensive. And in fact, it was the biggest social program until we get to Biden's aspirations today. But as a result of that, we had guns and butter, as the saying used to be. But the Vietnam War was so unpopular. Recall that poor old Johnson was followed around by students chanting, "Hey, hey, LBJ, how many kids have you killed today?" Not a thing I think that anyone would want to be subject to. But he did not feel able to tax the population to pay for these two programs. As a result, the fiscal deficit blew out, and inflation built under the overstimulation of an already fully employed economy. And it built by about 1% a year until by the end of the 60s, in 1969, inflation was 6%. And I think that's a very important observation to make, because historically, in the last 1,000 years, when we've had inflation waves, they have all started slowly and then built. And the reason for that is generally that expectations play a very big role in inflation. If people don't expect high inflation, then wage settlements are modest and price increases are modest. And obviously vice versa when they do expect it. And just the third thing to note is the scale. So the bottom of that fiscal deficit is 2.5% of GDP, a figure we can only dream of today. So obviously the price of gold was getting better and better value as inflation built. And there was very modest trading of gold. It was highly constrained. In private markets, it was significantly higher than the $35 it was fixed at the time. And the two countries which have been building large surpluses, trade surpluses, at the expense of the US, because their currencies were very cheap compared with the dollar, were Germany and Japan, and they were buying a lot of gold for their reserves. But it took de Gaulle to say, well, I'm going to change all my dollars into gold, because it's a good trade. Nixon wasn't having that, so he closed the gold window. And that was more or less the end of Bretton Woods. But if Bretton Woods was finished, the architect, John Maynard Keynes, still continued to dominate economic thinking. And this is a quote from him, that it is worse in an impoverished world to provoke unemployment than to disappoint the rentier. I'm sorry to say the rentier are all of us. There's no doubt that Nixon believed that his re-election prospects depended entirely on the level of unemployment. And so as a result of that, he pursued relentlessly stimulative policies, not just fiscal, but he also, in those days, of course, the central bank was not independent. He also ensured that interest rates would be negative in real terms at a time when the Wickselian natural rate was somewhere between 4 and 5%. The Wickselian natural rate today is currently calculated at about 0 to 1, so a very big difference. And he was aided by Burns, who's chairman of the Fed at the time. And Burns would be very concerned about the level of inflation that was being published. So Stephen Roach, who subsequently became a very distinguished chief economist for Morgan Stanley, told me that it was his unlucky job to take the numbers each month into Burns to tell him what the CPI was for that month. And Burns would say, why is it so high? Almost always, why was it so high? And the answer would be that, as it might be, bananas had doubled in price. Take them out of the index, said Burns. And by the time he left office, 65% of the items in the CPI had been thus removed. So inflation continued under that stimulus and persisted throughout the decade, aided but not dependent upon oil price rises. But it became more and more apparent that high rates of inflation caused tremendous social tension. So I was thumbing through an annual of Giles cartoons that I happen to have at home for this period. It is astonishing how dominant a theme shortages and strikes are. So probably 2 cartoons out of 3 would mention one or the other. So there were shortages of bread, shortages of petrol, strike a bell, and continuous strikes. And the strikes got worse and worse. And actually, if you think about it, I think it's quite easy to see why in one respect. Because if you've got inflation of 10%, the day after the settlement, you're fine. But the day before the next one, your real income has fallen by 10%. And undoubtedly, that's just not a comfortable situation to be. So social tension was great. This is obviously the winter of discontent, which I'm sure most of us remember in the late 70s. But the really important thing was all this stuff combined to make inflation the one intolerable feature. So it's the atmosphere at the time is well encapsulated by Theodore White, when he said, inflation is the cancer of modern civilization. It's a disease of money, and when the money goes, order goes with it. And there was a terrible sense that not only was inflation malign, but it was also uncontrollable. It was very difficult to see how it would be reduced. And as a result of that feeling, Keynesianism became less fashionable and was replaced in large parts of academic institutions by Milton Friedman and monetarism. And he did offer a way out. And by now, that way out, even though it seemed quite extreme, was attractive to the population as a whole. And Carter was able to charge Volcker with getting rid of inflation at whatever cost. And he did so by introducing very high interest rates. He was targeting the money supply, if you recall. But actually the cost wasn't that great, because importantly, the high rates of inflation in the 70s had purged balance sheets. If you were a corporate with too much debt, you hadn't survived until 1979. And the result of that was that even though rates were very high, nominal rates and real rates, particularly nominal rates were very high, but the economy suffered two rather minor recessions and then boomed. And disinflation followed for the next few years. But it's lasted rather longer than might have been expected. And Jay Powell has produced three reasons for that, which are, I think, fairly generally accepted today. So the first is demographics. Charles Goodhart's written a very good book laying out the demographic history. And the key thing is, of course, that with the opening up of China and the fall of the Berlin Wall, we added 1.6 billion people to the capitalist economy, and that had very powerful effects on the price of goods, but also on wages. And the price of goods was particularly helped because the expansion of globalization meant that Chinese goods were not only very cheap, but they were also achieving higher and higher market share in Western economies. So the goods inflation tended to be negligible, zero or even negative. Service inflation, because there isn't much productivity in services, follows wages. And that was rising at 3.5. But that was fine because the combination of the two meant that the targets, which had by then been adopted by all central banks of around 2%, were met, however easy monetary policy had been. And monetary policy had been extraordinarily easy since the mid-90s. And then the final influence was technology, which I think we all have seen the evidence of that. But the key point is that the impact of the internet has lowered prices, and the knowledge of prices charged by competitors has made it very much more difficult to raise price for people who had previously enjoyed oligarchic pricing environment. But one consequence of those extraordinarily low interest rates has been that debt has just exploded. So this is the US that I have shown here, but if you look at all the way around the world, this is true. It's worth noting that China now has corporate debt that as a percentage of GDP exceeds that of Japan in the late 80s when its bubble burst. And Japan, of course, that was followed by a 15-year, arguably 20-year recession driven by balance sheets, by people trying to rectify their balance sheets. So debt is very high, and the only reason, I'm not going to go into the debt problems, although they are extraordinary and worth a talk of their own, except to point out that what this has done is to make the economy extremely fragile. So one example of that would have been brought out by the Bank of England paper, actually 5 years old now, which said that nominal rates growing to 2.5 or 3% in the UK would cause more stress in the mortgage market than was happening at the peak of the great financial crisis. For sure, mortgage debt is a lot higher than it was then. So I think we know that short rates cannot go up by any substantial amount, which is very relevant because Janet Yellen says, I'm not worried about inflation because we have the tools to control it. And indeed, central banks have controlled inflation, but they have controlled it. Volcker was a very good example, by all sorts of different strategies actually, but they all involve high real interest rates. And I do not believe that with debt at its current level, it is possible to impose high real interest rates or anything like it without causing a depression. So that doesn't cause inflation. What it does say is that if inflation becomes embedded, it will be very difficult to control until the total volume of inflation, that's to say that the rate times the number of years, has been enough to get debt in better relationship with sustainable asset values and with incomes. And finally, just to point out that Kenneth Rogoff has written extensively on how high debt slows growth. The reaction, of course, in the short term has been just to stimulate more. So how does Powell's view stack up today? How do these factors look? Well, if we start off with demographics, Goodhart shows pretty plainly that that's turned around. Demographics move very slowly, of course, but we are already seeing the working age population, both of China and of the West, diminish relative to the elderly and young that they need to support. So that plank has been removed. Globalization, I hardly need to say, but for the last couple of years, if you define globalization as the percentage of world GDP represented by trade, it has been falling for a couple of years. And the current hostile environment towards China suggests that will continue for some time, as well as influences from COVID, which I'll get to in a second. Technology, I put a question mark. So actually, I think technology will continue to be a deflationary force, but probably rather less than it has before. So land securities came up with an interesting number the other day, where they said that in the world before COVID, so perhaps 5 years ago, retailers could comfortably absorb a cost of sales for rates and rent of 20%. And increasingly, they couldn't compete with the internet at that level. But their estimate now, this is I thought the interesting bit, is that at 13% they can compete. So that suggests that the internet has reduced cost of goods by roughly 7%. Is it not? So I'm sure that will continue, that trend will continue. But the rate of change, I suggest, will be very much less going forward. And then we get to green inflation. So the Labour Party aspirations expressed the other day by Rachel Reeves, so we're not talking about Corbyn out here, aspirations were to spend £28 billion a year on green investment. And that's about the same as the NHS, so it's a lot of money. The thing about investment in the environment is that although it addresses externalities that have previously not been addressed, there is no economic return. So that will be a very substantial additional burden. And on top of that, we've got taxes that are disappearing, for instance, on petrol, which have been very, very important for revenue. And we can anticipate they will be replaced by carbon taxes, which will obviously go straight through into inflation. And then, fortunately, we've got Helen Thompson here to give you the proper version of this, but I think that the energy situation is likely to be quite inflationary. And then we've got structural change. So Brexit is in the UK is definitely causing inflation. So if we look at the drivers, for instance, there's obviously a shortage at the moment, and wages have gone up a lot. But before the crisis, wages for HGV drivers had fallen from roughly 150 to 160% of a shelf stacker's wage to 125%. Unsurprisingly, there's a real shortage that had been building for some time of drivers coming forward. That was under the influence of competition, particularly from Eastern Europe. So when we go back to normal, which I hope we are doing now, obviously one would expect the £60,000 wages that they're currently enjoying to come under a bit of pressure. But I think the equilibrium level is not the 125%, it's the 150 to 160%, or maybe even a little bit higher. And that's just one of many aspects where the change in structure in the economy, both from Brexit and from COVID, will add additional pressures. And then I put pricking the asset bubble. So previous asset bubble burstings, so we're looking at 1720, 1825, 1873, 1929, were all followed by major and severe downturns. And those contractions obviously were very deflationary. But I don't think it's going to be the same this time. So I used to know a lovely old man called Teddy Butler Henderson, who some of you may remember. And he is an Austrian economist. But when he lived in Washington, he had a flat opposite to Greenspan's. And he and Greenspan would chat about prospect for life. At this stage, Greenspan was not chairman. But it was clear that he was on the way. And Greenspan told Teddy that he would defeat the fifth Kondratiev wave, in which Teddy was a big believer. Not many are now. But anyway, the fifth Kondratiev wave, by printing money. And I think that is a very instructive comment by a chairman of the Federal Reserve, which I think is reflected in his successors. So when we get what should be, in all other circumstances, a significant downturn with the breaking of the assets bubble, this time it will be met with huge further stimulus to the economy to prevent it going down. Now, whether it succeeds in the long term or whether it simply achieves high rates of inflation and then you get the downturn, it is unclear. So where are we today? So the general consensus is that we've got a high rate of inflation. Well, that's not arguable, it's over 5%. But that will diminish because that high rate of inflation has been caused by specific reopening issues. Shortages in shipping, semiconductors, and so forth. And I think that's probably right. Those reopening issues will get sorted out. But the consensus certainly used to be that inflation would, having had this little burst, would come back to something very close to target. And that still appears to be believed by about half the members of the Federal Reserve. But what I hope we have demonstrated here is that the medium-term pressures for inflation are sufficiently strong that we need to run our portfolios, A, to make some money out of that, but B, rather more importantly, not to lose it. Thank you very much.